Hey everyone, welcome to the first video of 2026. Before we begin, I wish you all a very happy new year. Now 2025 was quite a ride for investors. A year full of surprises, corrections and tough lessons. Markets did not behave the way many expected. Narratives changed and volatility reminded us that investing is not always smooth. But the key here is not to panic. The key is to reflect on what went wrong in 2025. What were the mistakes? And the learning from those mistakes. Honestly speaking, it's been 10 years for me in the market. Initial 5 years with job, next 5 years when I quit my job and pursued investing full time. And every single day, there's something to learn from the market. Every single day. And the more you learn, the more the stock market will make you humble. Because in the stock market, you are always a student. So starting 2026, I thought why not share the key learnings from 2025 that every serious investor should carry forward into 2026. Friends, 2025 lessons are especially important because bull market only boosts your ego. It's the bear market like 2025 that really shows the reality. So I have identified 12 such lessons that will help you navigate the markets better and invest more wisely going forward. Needless to say, it's worth watching the entire video and absorbing the learning. Alright, let's get started. So the first learning is valuations are supreme, always. One big narrative we kept hearing in 2024 and early 2025 was that FIs are selling, but it does not matter now. We are in Amrit Kal, India does not need foreign money, DIs and retail flows are more than enough. And honestly, it sounded convincing. Domestic SIP flow were at record high. Every dip was being bought. So it felt like valuation does not matter anymore. But 2025 reminded us of very old truth. Liquidity can only support prices, it cannot justify valuations forever. In 2024, many stocks were trading at 60, 70 or even 100 times multiple. And people justified their valuation saying that these are growth stocks where earnings are growing at 30-40% rate. But the catch is, no company can consistently grow at such high rate. And the moment earnings disappoint or let's say growth slowed even a little, those valuations tanked badly. And that's when reality hit. FIs exiting was not the real problem. The real problem was that expectations were way ahead of fundamentals. So the learning is very clear. Narratives change, liquidity cycle change, but valuation discipline never goes out of fashion. You can ignore FIs, you can believe in long-term India growth, but if you overpay, the market will eventually remind you. Maybe not immediately, but definitely. And that's the first lesson from 2025. Second learning is earnings matter more than stories. 2025 also exposed how dangerous it is to fall in love with stories. There was no shortage of great narratives. EV revolution, manufacturing boom, defense, AI, China plus one, capex cycle, PLI benefits. Every sector had a powerful narrative behind it. And for some time, stock prices moved only on these stories. But slowly, quarter by quarter, the market started asking a simple question. Where are the earnings? Many companies had excellent presentations, strong long-term vision, exciting future plan. But actual numbers like revenue growth, margins, cash flow, they were either flat or inconsistent. And once that gap between story and earning becomes visible, stocks corrected fast. On the other hand, companies that quietly delivered steady earning growth, even without flashy narratives, they protected capital much better in 2025. So the lesson is simple. Stories can help a stock re-rate, but only earnings can sustain those valuations. As investors, our job is not to predict the best story of the decade. Our job is to track whether earnings are actually catching up with the expectation or not. Because in the end, numbers matters, not narratives. Third learning is, right portfolio allocation is a must. So 2024 was the year when retail investors blindly chased return. As a result, portfolios became heavily skewed towards your small caps, micro caps, SME stock that were going up crazily. 2025 exposed the flaw in that approach. Small and micro cap stocks do not just offer higher upside, they also carry significantly higher volatility. When market conditions tighten or earnings disappoint even slightly, these stocks tend to correct much faster and much deeper. Investors who build portfolios with 70-80% exposure to small, micro or SME stocks have faced heavy losses in 2025. Not necessarily because all businesses were bad, but because the portfolio construction itself was weak. This phase reinforced an important lesson. Investing is not only about maximizing returns during bull market. It is about managing risk across cycles. Large caps provide stability during uncertainty, mid cap offers a balance of growth and risk, and small caps can add alpha, but only when used in moderation. Your focus should always be risk-adjusted return. A portfolio that performs well only when the markets are favorable is not a strong portfolio. The real test of portfolio happens during the bear market. Then fourth learning is markets will always be volatile. Patience is the key. Every year during the bull run, we feel like the market will continue to generate high returns. But the market keeps reminding us that stock investing is not a cakewalk. It is full of volatility. And one thing 2025 made very clear is that volatility is part of the equity investment journey. In this journey, you will see both ups and downs, sharp rallies, sudden corrections, sectoral rotation, and long phases of time correction. They're all part of the investing journey. In this situation, investors who stay disciplined, stick to their allocation, and allow time to do its job come out far better than those who react emotionally to every headline or price movement. If there's one permanent skill in investing, it is the ability to stay invested and think long term when the market does everything possible to distract you in the short term. Then fifth lesson is conviction matter more than timing. 2025 correction clearly separated investors with conviction from those who are only riding momentum. Many people bought stocks simply because prices were going up, sectors were in trend, or someone on social media sounded confident. But when markets corrected and volatility increased, those investors were left completely confused. They didn't know whether to sell, hold, or accumulate because they never had an idea what they owned and why they owned it in the first place. Friends, conviction does not come from stock tips or past price performance. It comes from knowledge, understanding the business model, earning drivers, valuation comfort, what are the risks involved. I always say that before investing in the market, investing in knowledge. Learn the art of investing, so that you can avoid the majority of investment mistakes at the very first place. And if you really want to learn the art of investing, you can explore my exclusive weekly series. Here I track nearly 200 companies and also share my own investment thesis. Why I'm buying a stock or why I'm selling a stock. The goal is to empower you with the right knowledge so that you can invest with conviction. Friends, in last 15-16 months of market correction, it has resulted in very good opportunities. So if you have been waiting to invest in your knowledge, this phase of market might be the right time. For more details, you can explore my website or join button of this channel. Also for the website, there's an additional 15% discount on New Year, but only for a limited slot. Promo code I have provided in the pinned comment. Then sixth learning from 2025 is avoid social media narratives. One of the biggest pattern I've observed in 2025 was how social media narrative tend to peak after prices have already moved significantly. In most cases, a sector, theme, or stock starts getting attention only after it has delivered strong return. By the time everyone is talking about it, sharing charts and calling it the next big opportunity, a large part of the move is already behind us. This was visible again towards the end of 2025, when metals like gold and silver became widely discussed across platforms. Today, everyone wants to buy gold and silver because they've generated massive return in 2025 and everyone is talking about them over social media. Typically, this is the phase when informed investors start reducing exposure or book profit, whereas amateur investors buy them, driven by FOMO, that is fear of missing out. That's how weak hands get trapped at high levels. Friends, social media is not designed for timing or risk management. It is designed for engagement. Narratives are amplified when emotions are high, not when valuations are attractive. As investors, the goal is not to avoid popular sector altogether, but to be cautious when a theme becomes obvious to everyone. So going into 2026, I have been very careful of metals. In fact, I believe that in 2026, your equity should again outperform commodities. Then seventh learning is hated businesses require close tracking. That is the contra mindset. 2025 also reminded us that if a sector or theme or stock is highly hated over social media, it is worth tracking it very closely. Because when a stock or theme is hated, could be due to temporary reason, in that case, nobody wants to buy it. And that's when you can get a very good valuation. Friends, it is very important to note that contra investing is not about buying anything that has fallen or is unpopular. Hated business can offer strong opportunity, but only if they are fundamentally strong and the correction is due to temporary problem. Many investors mistake low prices for value and they ignore what is actually happening inside the business. Here, please note that a true contra mindset requires constant monitoring, be it the quarterly earning, balance sheet strength, management commentary, industry data, and competitive positioning. If the business stabilizes or starts showing improvement while sentiments are still weak, that's where real opportunities emerge. If fundamentals continue to deteriorate, a falling stock can quickly turn into a value trap. I've already started a series on contra investing. Then eighth learning is always take management commentary with a pinch of salt. One of the biggest lessons from 2025 is management commentary should always be listened carefully but never be believed blindly. Managements are naturally optimistic about their businesses. They never discuss the antithesis or key risk in their business. And during difficult phases, sometimes they use words like temporary slowdown or strong pipeline or next quarter recovery. But that does not always translate into number on ground. There are many examples in 2025 where management continued to sound confident in earning calls even when the revenue growth slowed, margin compressed, or where there were execution issues. Investors who relied only on commentary without validating it through actual results ended up holding stocks much longer than they should have. The market ultimately does not reward confidence, it rewards execution. The right approach is to treat management commentary as a hypothesis, not a conclusion. Listen to what they say, but verify it with quarterly performance, order inflow, cash flow, and balance sheet movement. If commentary and numbers they move in the same direction, then your conviction should strengthen. But if there's consistently a huge gap between management commentary and actual performance, it is better to be very cautious. The ninth lesson is you cannot have all the winners, but you must cut the weak ones. 2025 was a good reminder that no portfolio will ever have all the winners in the same time. Expecting every stock to perform well is unrealistic. The real skill in investing is not perfection, it is decision making. Knowing which businesses deserve patience and which ones don't is what ultimately protect capital. One thing I have observed is many investors hesitate to exit weak businesses because they don't want to book loss. They wait for a long period, hoping prices will come back, even when fundamentals continue to deteriorate. But holding on to a broken business just to avoid booking a loss often leads to deeper damage. On the other hand, strong businesses going through temporary price correction deserve time and conviction. The key is to separate the price weakness from business weakness. Exiting weak businesses, even at loss, is part of disciplined investing. That capital can be redeployed into stronger companies where conviction is high and long-term visibility is better. 2025 reinforced that returns don't come from owning everything. They come from owning the right businesses and having the courage to act when the thesis changes. 10th lesson is don't stress over what you can't control. 2025 also reinforced a very practical truth about market. It does not care how much profit or loss you are sitting on. Prices move based on thousands of variables, both local and global, most of which are completely outside an individual's investor's control. See, you have factors like macroeconomics, geopolitics, interest rate, liquidity flow, policy decision. None of these respond to your personal situation. Friends, if you really go deep into each of these issues, you will go mad. As an investor, what we can control is position sizing and risk exposure. When too much capital is deployed in equity or in high-risk stock, every market move starts affecting mental peace. What is the solution? Simple. Invest only the amount that allows you to sleep peacefully at night. If market swings are causing you anxiety, it's a signal that your risk levels may be too high. Long-term investing works best when your mind is calm because patience, discipline, and rational thinking are impossible without mental comfort. 2025 showed that protecting peace of mind is just as important as protecting capital. Then 11th lesson is it's always good to have some gold in portfolio. 2025 again showed why our ancestors always trusted gold and why gold holds so much value in our culture and tradition. So the learning is it's always sensible to keep a small allocation to gold in the portfolio. Gold does not exist to generate high returns like equity. Its role is protection. During periods of uncertainty, volatility, currency weakness or geopolitical stress, gold tend to hold value when equity struggle. Personally, I ignored gold because I was too focused on equity. And that is one big learning. When markets correct or move sideways for a long period, gold really helps balance the portfolio and reduce the overall drawdown. That stability becomes extremely valuable during stressful phases, not from return perspective, but from risk management perspective. And the final lesson is mistakes are part of the journey. 2025 clearly reminded us that mistakes are inevitable in investing. No one gets it right at the first time. The key is not to avoid them completely because that's impossible. The key is to learn from each mistake, understand why it happened, and take steps to ensure it does not repeat. Over time, this process of reflection and course correction builds judgment and strength conviction and makes you a better investor. So those were the 12 important learnings from 2025. If there is one takeaway, it's this. Investing is a journey, not a sprint. Valuation matters, earning matters, conviction matters, and patience is everything. Markets will continue to be volatile. Mistakes will happen. But disciplined investors who focus on learning, risk management, and the right businesses are the ones who will win over time. As we move into 2026, take these lessons with you, focus on knowledge, build conviction, and remember, it's not about avoiding mistakes. It's about learning from them and staying calm when the market gets noisy. I hope 2026 brings more prosperity, better clarity, and steady progress in your life. Wishing you a focused and successful investing year ahead. So this is it for this video. If you find it useful, do share it within your circle. And I would love to know which is your biggest learning from stock market in 2025. I'll see you next video. Till then, take care.